Welcome to Iron Financial, the only explainer you need to forge a stronger portfolio and cut straight through the noise of market weakness. I'm your lead analyst, and today we're conducting a hard-hitting structural audit of Meta's massive Q1 2026 earnings report. We're going to look under the hood, inspect the foundation, and literally weigh the load-bearing metrics of one of the biggest tech juggernauts on the planet. But look, I'm not just here to read you a balance sheet. Throughout this explainer, I'm also going to be putting on my market skeptic hat. I'm going to be asking the exact questions you're probably screaming at your screen right now. Is this current AI boom actual structural reality? Or is it just another layer of corporate scaffolding hiding a really fragile foundation? Because in a market where big tech is supposed to be absolutely bulletproof, seeing a giant stumble on a win, yeah, that's jarring. Let's dive right in. Right out of the gate, we have to point out a glaring paradox. We are looking at a quarter that on paper looks like a towering skyscraper of success. Meta reported a massive 33% revenue surge. I mean, for a company of this size, that kind of growth is almost unheard of. Yet, almost immediately after these numbers hit the wire, what happened? The stock dropped 6%, a massive immediate sell-off. So if the building materials are this good, why on earth are investors running for the emergency exits? What we have here is the absolute core tension of this entire structural audit. On one side of the scale, Meta's rock-solid revenue foundation, $56.31 billion generated in just 90 days. That represents undeniable steel beam strength. But on the other side of the scale, we have that immediate market reaction with shares dropping 6%. The market is incredibly unforgiving right now, and investors seem to be suffering from short-term memory loss. They absolutely love a $56 billion quarter today, but they are terrified of the heavy lifting required for tomorrow. We have to figure out, are they building the future, or are they just digging a very, very expensive hole? Section 1. The solid foundation. Forging a $56 billion quarter. Let's get into it. To answer that big question, we have to start down at the bedrock. Let's drill down into Meta's family of apps. We really need to understand the sheer volume of raw cash this ad engine is pumping out before we can critique what they're spending it on. Look at the raw materials here on the slide. Focus specifically on that income from operations line. $22.8 billion. That represents a staggering 41% operating margin. Listen, in the business of heavy tech infrastructure, pulling a 41% margin right now is almost mythical, especially given the massive inflation in compute costs we're seeing across the board. It's practically indestructible. And on top of that, net income surged 61% year over year to $26.7 billion. Now, putting on my skeptic hat for a second, to be totally transparent with you, there is a footnote. That massive EPS of $10.44 actually includes an $8 billion tax benefit from the U.S. Treasury addressing R&D costs. So actually scratch that. It's not all pure operational sweat. Excluding that tax benefit, the EPS would be about $3.13 lower. But even factoring that in, the operational income growth of 30% year over year proves the core foundation is entirely sound. The year-over-year growth trajectory here is just undeniable. First quarter of 2025, $42.3 billion. First quarter of 2026, $56.3 billion. We aren't just looking at top-line fluff fueled by clever accounting tricks. This is concrete bottom-line profitability. They are converting top-line revenue into net income at a ruthless, highly efficient rate. This basically proves that Mark Zuckerberg's famous year of efficiency, layoffs, and all that restructuring from the previous year weren't just a temporary fresh coat of paint. They actually reinforced the foundation, making the entire operation leaner and exponentially more profitable. But as a skeptic, you should be asking, where exactly is this growth coming from? Are they just squeezing their existing users harder, or are they actually expanding the physical footprint of this building? Well, the truth is they're doing both. $3.56 billion. I want you to just pause and think about that number for a second. That is the number of daily active users across Meta's family of apps. So we're talking Facebook, Instagram, WhatsApp, Messenger, and Threads. 3.56 billion people every single day. That is nearly half the human population of planet Earth logging into this ecosystem daily. Capturing new human attention at this ridiculous scale is structurally incredibly difficult. There are only so many hours in a day, right? And nearly half the planet is spending a chunk of them here. That user base is actually up 4% year over year. Even with temporary headwinds like internet disruptions in Iran or WhatsApp restrictions in Russia, the structural integrity of their user base remains completely intact. The growth hasn't capped out at all. The foundation is literally still widening. But here are the load-bearing metrics you really need to care about. This is how the engine actually prints money. Ad impressions delivered across the apps increased by 19%. At the exact same time, the average price per ad increased by 12%. Now, hold on, let me stop right there. My inner skeptic is screaming because that defies basic supply and demand. If you flood a market with 19% more ad inventory, the basic laws of economics dictate the price should plummet, right? How on earth is Meta simultaneously serving way more ads and charging a 12% premium for them? Honestly, it sounds like a bubble waiting to burst. But it's not a bubble. It's the architecture of their new artificial intelligence. Let's move to the next slide and see exactly how this is built. The secret to serving more ads while charging more for them all comes down to targeting efficiency. Meta has completely retrofitted their advertising engine with what they call the GEM model and sequence learning architecture. Okay, let's explain that in plain English because it's a real game changer. Imagine the old algorithm looking at a single brick you bought online and trying to guess what you want to buy next. It's a guessing game. Sequence learning, on the other hand, looks at the blueprint of your entire life. It looks at the house you're building, the specific DIY tutorials you watched on Instagram, the links you just sent your contractor over on WhatsApp. Because this AI understands the full structural sequence of your behavior across a much longer timeline, it places the absolute perfect ad right in front of you. Advertisers are more than happy to pay a 12% premium because these ads actually convert into real sales. The AI is structurally reinforcing the entire ad funnel. And here is the tangible, hard cash return on investment for that AI integration. This isn't just corporate buzzword bingo. This is real-world ROI. They literally doubled the number of GPUs to train this GEM model. They aren't just buying software licenses, folks. They are physically hoovering up the global supply of silicon to power this brain. When you double your GPU count, you are building one of the largest compute engines on Earth. And the result? A 3.5% lift in Facebook ad clicks, and over 1% gain in Instagram conversions. And most impressively, by using AI to dynamically redistribute ads to the exact moments when users are most likely to click, they generated a 4 times larger revenue impact than if they had just blindly increased the ad load. It's highly, highly efficient. Okay, I'll admit, those are impressive structural reinforcements. But I just mentioned they doubled the number of GPUs. Let's be real, GPUs are not cheap. NVIDIA isn't exactly giving those away for free. Which brings me to the absolute elephant in the room. Is this AI acceleration, or are they just throwing billions of dollars into a furnace to keep this engine running? We need to pivot this structural audit straight over to the liabilities column. Because if maintaining this technological edge requires them to spend everything they earn, then this shiny tech fortress is a lot more fragile than it looks. Section 2, Heavy Lifting, the $145 billion infrastructure load. We are now entering the heavy lifting phase of this explainer, and this is where Wall Street gets vertigo. Meta's ballooning capital expenditure forecast. On one hand, you have that incredible $56 billion quarter we just talked about. But then, Meta drops a bomb. They are revising their full-year 2026 Capex, that's their capital expenditures for physical infrastructure, to a staggering range of $125 to $145 billion. That is a massive, massive chunk of their operating income being plowed straight back into the dirt just to build AI data centers and procure chips. Let's actually read the fine print directly from the CFO's notes here. The Capex hike was previously projected at $115 to $135 billion. Now it's pushed up to $145 billion. Why? Well, the CFO explicitly states it reflects higher component pricing this year and, to a lesser extent, additional data center costs to support future year capacity. Higher component pricing. In other words, they are victims of the global supply shortage. Everybody and their mother wants AI chips right now, so the suppliers are hiking the prices, and Meta just has to swallow that premium to stay competitive. They are basically buying the most expensive bricks in the world right now to build these AI data centers. They're trapped in an arms race. If Meta blinks and stops buying these highly contested NVIDIA chips, their competitors are going to build a taller skyscraper, and Meta's foundation begins to sink. It's a structural necessity, but that price tag, it's terrifying the market, which perfectly summarizes the street's fear. Just look at this quote from Jesse Cohen over at investing.com. Investors are digesting the reality that Meta's ambitious AI ambitions come with a hefty price tag that will pressure profitability in the near term. This right here is the classic value trap warning. For those watching, a value trap is essentially a building that looks incredibly cheap to buy, but the maintenance costs will completely bankrupt you. If we see consecutive quarters of these rising infrastructure costs coinciding with even a slight deceleration in revenue growth, man, the narrative permanently shifts from building the future to burning cash on a speculative vision. But let's take a breath and look at exactly what that $145 billion is forging. They aren't just buying off-the-shelf parts here. They are advancing their own proprietary MTIA silicon chips. This is absolutely crucial structural planning.
By advancing their own silicon, Meta is actively trying to escape the exact component pricing squeeze we just talked about. They don't want to pay the NVIDIA tax forever. Taking the hit on R&D right now to fabricate their own chips means they eventually own the factory, not just rent the tools. They've also expanded their Andromeda ads retrieval engine so it can run efficiently across NVIDIA, AMD, and their own MTIA. And they just released Muse Spark, the first model from Meta's Superintelligence labs. So yes, they are enduring these global supply shortages right now, but they're doing it to build a proprietary, indestructible AI hardware foundation for the next decade. If they stop building today, the whole structure collapses tomorrow.
Section 3. Cracks in the armor. Reality Labs. Okay, I can buy the argument that AI infrastructure is a necessary, albeit wildly expensive pillar. But my skeptic side is forcing this audit to examine Meta's most notorious, undeniable crack in the armor. I pulled the raw segment data directly from the report to expose this stark contrast. Look at this. The family of apps, the ads, Facebook, Instagram, generated almost $27 billion in profit. Incredible. Then look directly below it. Reality Labs generated an operating loss of $4.02 billion in a single quarter. It is undeniably the heaviest anchor on their balance sheet. It is a major liability that drags down the pristine efficiency of the core ad business. Honestly, calling it an anchor is putting it lightly. The economics here are just brutal. Reality Labs brought in $402 million in revenue. That revenue is mostly hardware sales, right? Quest 3 headsets and Ray-Ban smart glasses. But maintaining those product lines, pushing software updates, and researching next-generation optics requires a terrifying amount of R&D. It cost them $4.02 billion to run this division. That is an exact 10-to-1 ratio of operating losses to revenue. Let me repeat that. For every single dollar they make in VR, they set $10 on fire. How do you possibly defend that kind of structural weakness? Well, you defend it by looking at the very long-term blueprint. Mark Zuckerberg stated on the earnings call, "I think that we're at a moment similar to when smartphones arrived, and it was clearly only a matter of time until all those flip phones became smartphones." Let's look at the recent history to understand why he's so paranoid about this. Just a few years ago, Apple introduced the app tracking transparency privacy changes to iOS. Because Apple owned the phone, they changed the rules, and it literally cost Meta roughly $10 billion in lost ad revenue in a single year. Meta realized right then and there that their entire $56 billion foundation is built on rented land owned by Apple and Google. They are completely at the mercy of mobile operating systems they do not control. So they are bleeding $4 billion a quarter right now to ensure that when the world eventually shifts from phones to AR smart glasses, Apple doesn't control the toll booth. If Meta owns the glasses and the operating system, they own the absolute foundation of the next generation of computing. It's a massive, massive gamble, but to them, it's a structural necessity to secure their corporate sovereignty. Section 4. The final verdict. Opportunity or value trap. So, we've audited the foundations, we've inspected the heavy infrastructure costs, and we have analyzed the deepest cracks in the armor. Let's synthesize the data for our final iron financial verdict. Are we looking at a generational buying opportunity on this dip? Or is Meta a dangerous value trap? Here are the final weights on the scale. On the bull foundation side, you have an ironclad 41% operating margin, 33% revenue growth driven by highly efficient sequence learning AI ad targeting, and an $81 billion cash war chest just sitting on the balance sheet. This ad engine is completely unmatched and highly durable. But on the bear side, those cracks are deep. You have a terrifying $145 billion Capex load, driven by severe component shortages and an endless arms race for silicon. You have a continuous $4 billion quarterly bleed from Reality Labs, with painfully slow consumer adoption. And most dangerously, you have a market that actively punishes speculative visions, with massive sell-offs the very moment the bill comes due. Which brings us to the ultimate question for you, the investor, to answer. Will Meta's massive AI infrastructure load bear the weight of the market's expectations? Are they building an indestructible fortress for the future of artificial intelligence, or are they digging an incredibly expensive hole chasing a metaverse dream? The numbers are out there, the blueprints are exposed, and we've done the heavy lifting. Now it's your turn to decide if this foundation is strong enough for your capital. Thanks for joining us for this structural audit. Take this data, weigh the risks, and go out there and forge a stronger portfolio. Stay vigilant, keep inspecting the blueprints, and we'll see you on the next explainer.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.